Let me tell you something most investors never learn until after the move. The biggest money is rarely made when the headline becomes loud. It is made when the rule changes quietly in the background, and almost nobody notices until the repricing is already underway. That is the real story here. Not silver by itself. Not some old metal your grandmother kept in a drawer. Not a weekend hobby for people who like shiny coins and apocalyptic arguments. This is a story about plumbing, about ratios, about rules, about how one market can look sleepy on the surface, while the structure underneath it is being altered in ways that eventually force almost everything around it to reprice. That is what I want you to see, because when people hear the word silver, most of them make the same mistake immediately. They think this is a metal story. They think it belongs in the same metal bucket as gold commercials, bullion dealers, and those old arguments that come back every time inflation rises or the banking system looks a little sick. Silver is doing something more dangerous than that. Silver is sitting at the intersection of industrial necessity, monetary distrust, paper leverage, and regulatory change. That is a very different setup. And if you understand it early enough, you stop asking the lazy question, is silver going up? And start asking the much better question. What happens when the floor under paper supply gets quietly raised while industrial demand keeps eating real metal? That is the whole game, and the reason almost nobody sees it is simple. People are always looking at price. Price is noisy. Price is emotional. Price is full of television opinions, dollar moves, Fed commentary, and the usual circus of modern finance. I prefer ratios. Ratios tell me one thing against another thing, cleanly without all the screaming. That is why the first chart I care about in this whole setup is not the silver chart alone. It is silver divided by the S&P 500. Think about what that means. It tells you how expensive silver is compared with the broad American stock market, not in absolute dollar terms, but in relative value terms, and relative value is where some of the clearest opportunities in markets usually hide, because absolute prices can fool people while ratios expose how distorted the comparison has become. If the ratio is high, silver is expensive relative to stocks. If the ratio is low, silver is cheap relative to stocks. That is it. Simple. Now here is the uncomfortable part for anyone ignoring silver right now. This ratio is sitting near one of the lowest levels of the modern era, not slightly low, not kind of cheap, historically stretched, which means silver relative to the American stock market is trading in one of the cheapest zones seen in decades. That matters, because when this ratio has bottomed at prior extremes, the next chapter has not usually been calm. It has usually been violent. Silver has gone from ignored to loved with extraordinary speed. And the people positioned early looked brilliant later, even though what they were really doing was just paying attention to a setup the public could not be bothered to examine while everyone else was busy staring at whatever was fashionable that year. This is one of those moments again. I am not promising you that Friday afternoon will look dramatic. I am telling you that the relative setup is rare. The plumbing is changing, and history takes those combinations more seriously than most investors do. Now let me explain why this ratio matters so much. Stocks have had a magnificent run for a long time. They have absorbed capital, optimism, pension money, index flows, 401k contributions, artificial intelligence enthusiasm, productivity dreams, buybacks, and all the other currents that have made the broad American market the default home of modern savings. Fine, meanwhile, silver has remained the neglected cousin, too industrial for the pure monetary crowd. Too monetary for the pure industrial crowd, too volatile for cautious people, too boring for momentum people, too old-fashioned for technology worshippers, too practical to fit neatly into any of the stories. Modern finance likes to tell about itself. That is what makes it so interesting. When something useful is neglected for too long while something beloved becomes relatively expensive, you do not need a perfect catalyst. You simply need the structure to tighten enough that capital starts moving back toward what was ignored. That is how the ratio works. Now, if this were only a valuation story, it would already be worth watching. But it is not only a valuation story. It is also a rule change story. And quiet rule changes are where some of the biggest reallocations in financial history begin. People still think markets are mostly moved by speeches, earnings reports, and dramatic geopolitical events. That is what the public sees. But if you spend enough time around real markets, you learn something more important. Often the deepest moves begin when a regulation, reserve treatment, funding requirement, or balance sheet rule gets altered in a way that looks technical, boring, and irrelevant to almost everyone except the people whose job is to move large amounts of capital in response to it. That is what has happened here. Basel III. Most people hear that phrase and mentally leave the room. I understand why. It sounds like the kind of thing designed to make normal human beings feel sleepy before the real sentence has even started. But what matters about Basel III is not the title. It is the consequence. And the consequence is that holding unallocated silver became more expensive for banks. That sentence matters more than it sounds. Let me strip the jargon out of it for years. Large banks could operate inside the silver market through paper promises more comfortably than most ordinary investors realized. Unallocated silver means in practice that there is not necessarily a specific bar with your name on it sitting quietly in a vault. It is a claim, an IOU. A paper market representation, a promise structure layered over real metal. That paper structure matters because it allows far more silver exposure to exist financially than may exist physically in immediately deliverable form. That is how leverage gets created in commodity markets. That is how price can be managed, smoothed, pressured, or diluted by claims that are not the same as people showing up demanding actual bars. Now enter the net stable funding ratio. Again, terrible phrase. Very important consequence under the newer rule treatment. If a bank wants to carry unallocated precious metal exposure, it must support that exposure with much more stable funding than before. In plain English, the old paper game became more expensive to maintain. The paper promise now consumes more balance, sheet oxygen. That changes incentives immediately. What was once a profitable friction, light trading habit becomes heavier, less elegant, more annoying, and when you make a large bank balance sheet habit more expensive, you do not need to scream for change. The bank changes because the economics changed. That is what matters. The cost of carrying paper silver went up, and once that happens, the incentive to carry real allocated metal relative to unallocated exposure becomes stronger. This is not mystical. It is accounting pressure, and accounting pressure moves huge amounts of money precisely because it looks boring enough that the public never notices it. This is why I say quiet rule changes matter so much. They do not ask for your opinion. They do not need a public campaign. They simply alter the game board and let balance. Sheet logic do the rest. Now think through what that means for silver. If paper leverage becomes more expensive and less attractive, then the part of the market that used to suppress the importance of physical metal loses some ease. Physical silver starts mattering more, not because somebody made a passionate speech about it, because the cost structure changed. That is a floor shift and floor. Shifts in market structure can be vastly more important than the public headlines people spend their days reacting to. This is why I keep coming back to the same line. The silver story is not really a silver story. It is a rule story. It is what happens when the machinery behind a market changes, while the people watching the front of the machine still think everything is basically the same. That is where the repricing comes from. Now let us add the second change, because one rule shift by itself is powerful, but two from different directions is where a true squeeze in logic begins to form. China, you cannot understand silver anymore without understanding China, because silver is not primarily a decorative metal. Now it is one of the industrial lifeblood metals of the modern world. Solar electronics, electric vehicles, high performance conductors, medical systems, industrial applications that require reliability in how electricity moves. These are not side stories. This is the industrial future wearing a metallic skin, and China sits close to the center of that demand system. When China changed its export licensing framework and tightened the way silver leaves the country, this was not some tiny bureaucratic event with no consequence. It was another invisible floor shift, not loud, not theatrical, practical. China is both a massive user of silver and a major handler of refined silver flows. So when it narrows the doorway through which silver exits, the rest of the world does not get to shrug. The rest of the world has to compete harder for what remains available outside that narrowing door that matters, because silver is one of those markets where people routinely talk as though supply is abundant until you start asking supply for what? Exactly. Supply for speculative paper contracts. Probably supply for industrial use at scale in a world of rising solar demand, EV demand, electronics demand, data center build-out, and growing physical preference. That is a different question, and this is where I think ordinary investors fall asleep at the wheel. They hear commodity and think the supply side must respond cleanly and abundantly to higher prices. Not always. Mines take time, refining takes time, logistics take time, political conditions matter, costs matter, the quality of deposits matters. The whole fantasy that industrial demand and physical scarcity can be solved instantly by shouting capitalism into the air is childish. Real supply is slower than financial conversation. That is what makes silver so interesting here. Now let us bring in the demand side more directly, because this is where the case stops being interesting and starts becoming forceful. Solar alone consumes an astonishing share of annual silver supply, 1 in 5 ounces of global mine production, effectively being pulled into solar. Related demand is not a rounding error. It is not a niche trend. It is a major industrial claim on a metal that people still talk about as though it were mostly jewelry and bullion. That is outdated thinking. Then layer in electric vehicles, where the electrical complexity is greater than in conventional cars, then data centers, then 5G and electronic infrastructure. Then all the little industrial applications that never get television coverage because they are too boring for media and too necessary for the real world to care whether cameras are pointed at them. This is what I mean when I say the physical world matters more than the narrative world. Narratives can drift. Physical demand cannot bluff forever. And when the physical demand remains strong while the paper framework becomes less elastic and a major refining export actor tightens the door, the setup begins to look less like a speculative thesis and more like a structural tension. That is a much more serious thing. Now let us talk about comics, because this is where the public argument usually gets sloppy. There are always people shouting that the vaults are about to be empty by Tuesday. I do not find that kind of drama useful. On the other side, there are always people saying there is no issue at all. Everything is functioning perfectly. And any discussion of inventory stress is just the hobby horse of metal obsessives. That is lazy too. I prefer something stricter, not empty tighter. That is the word I trust. What matters is not whether silver fully disappears from a warehouse tomorrow morning. What matters is whether registered inventories, deliverable inventories, physical drawdowns, and the relationship between paper claims and real metal are moving in a direction that makes the system more fragile to demand surges and less able to absorb stress quietly. That is the adult question. And the answer, from what the source material is highlighting, is yes, tighter, more stressed, less comfortable, not apocalyptic, less buffered. That is enough. You do not need zero inventory for prices to move hard. You only need enough tightening that the marginal ounce begins commanding a different price, because too many people want the real thing and too much of the market was built around the assumption that a paper promise would keep doing the job. That is the pivot. Now here is where I think the broader investing public is making a very serious mistake. They think this is only relevant to people who already own silver. Wrong. If you own stocks, this matters. If you own index funds, this matters. If your retirement is mostly tied to the S&P 500, this matters. Because the silver versus stocks ratio is not just a chart for metals enthusiasts. It is a relationship chart between a neglected hard industrial monetary asset and the most crowded savings vehicle in America. When one side of that relationship is historically cheap and the structural backdrop beneath it is tightening, that has implications for asset allocation, for what is overowned, for what is underowned, and for how the next large rotation might look if conditions line up. That is why I keep returning to ratios. Ratios expose neglect. Ratios expose crowding. Ratios expose where the spring may be coiled, even if the public still thinks the story sounds silly. And if silver begins a violent repricing against stocks, then the people who assumed index ownership alone was enough exposure to the future may discover that some of the future was hiding in a place they never bothered to examine. That is a hard lesson. Now, I want to be very disciplined and very fair. Silver is volatile. Anyone telling you otherwise is trying to sell you something. Silver is not a retirement core the way a broad market index is. Silver is not a substitute for skill, business ownership, productive equity, or a sound balance sheet. Silver is not the asset you go all in on because a YouTube video made you emotional on a Tuesday night. That is not my argument. My argument is narrower and I think more intelligent. When a ratio reaches extreme historical cheapness, when regulatory treatment shifts against paper leverage, when a major physical processing export channel tightens, when industrial demand remains relentless, and when inventories are becoming less comfortable, the asset deserves respect, not worship respect. That is the correct posture. And respect leads to process. That is why I like the three signal framework buried inside the source material. It is one of the strongest parts of the original because it stops this from becoming a pure emotion story. Signal 1 is the ratio. Silver versus the S&P 500. Where are we relative to 50 years of history? Not your feelings. History signal 2 is the supply. Demand balance. Are we still in a world where more silver is being consumed than is being newly supplied through mine output and recycling? Not a one-week rumor. The actual balance signal 3 is the rule book. What has changed in the regulatory, banking, export, and official treatment of silver that makes the old assumptions less reliable? Those three together create a much better discipline than price. Chasing, that is the real value of the setup. Not silver will moon. That is childish language. The real value is that the investor can begin to replace gambling with a checklist. The ratio is stretched, supply is tight, the rule book changed, fine. That is actionable thinking. And again, I am not telling anyone what to buy. I am telling you how I would think. That is a very different thing, because thinking properly is what prevents the two great errors around an asset like silver. The first error is dismissing it as a barbarous relic with no modern relevance. That is obviously wrong. The industrial case alone refutes it. The second error is turning it into an apocalyptic religion where every ounce is treated as a ticket to escape the end of civilization. That is also wrong. The interesting place is between those two foolish extremes. Silver, as a structurally mispriced, partially monetary, heavily industrial asset, whose market plumbing is changing in a way the average index investor has not even begun to factor into his mental model. That is interesting. That is serious. That is worth study. Now let me take this one level deeper, because I think this is where the setup becomes especially important for a Buffett-style mind. I have always believed the great fortunes are built by understanding the difference between what is merely popular and what is structurally valuable. Popularity changes fast, structure changes slowly, and when a slow structural change finally forces a price to move, the move often looks sudden only to the people who are not watching the structure. That is exactly what this feels like. Silver does not need to be on the front page every day. It does not need your friends talking about it at dinner. It does not need Wall Street sales desks pushing it like the latest big thing. It only needs the physical market to keep tightening, the regulatory framework to keep favoring real metal over paper convenience, and the ratio to remain distorted long enough that when capital does finally move, it finds the whole thing much tighter than expected. That is how life-changing moves happen. Not because everybody agreed, because most people were busy elsewhere. Now let me say something about sizing, because adults need sizing and children need dreams. An asset this volatile should be sized with humility. If a 20% decline would cause you to lose sleep, panic, or abandon the position, then you have already sized it incorrectly. A good allocation is one you can hold through discomfort because you understand the role it is playing. That is the same rule I would apply to any non-core asset. Silver does not need to be the center of your world to matter. A measured allocation inside a broader structure can still matter a great deal if the asymmetry is real. And if the asymmetry is not realized soon, then the position should still be tolerable enough that you are not emotionally destroyed by waiting. That is how disciplined money behaves. Now let me come back to the stock market one more time, because I think this is where the lesson becomes biggest. Most people still behave as though the future belongs automatically to the assets that dominated the last 5 years. That is an understandable error. Success attracts more capital. But markets are ruthless toward crowding. The more one side of the boat becomes loved, the more important it becomes to ask what is being left behind, especially when what is being left behind is not some broken industry, but a vital industrial input with a monetary shadow and a tightening physical story. That is what silver is. And when I see something that's cheap relative to stocks with that much structural pressure under it, I pay attention, not because I need drama, because I respect asymmetry. That is the proper word here. Asymmetry, limited emotional popularity, clear industrial need, tighter physical conditions, regulatory pressure against paper ease, extreme relative cheapness. Those ingredients do not appear together often. When they do, they deserve study. That is the whole message I would leave you with. Do not become a fanatic. Do not become dismissive. Do not confuse a quiet setup with an irrelevant one. And above all, do not wait for the evening news to tell you that a rule change mattered. By the time the evening news can explain it, somebody else will already have been paid for noticing it first. That is how markets work. They do not reward awareness equally. They reward early awareness disproportionately. So if I were you, I would not ask whether silver is exciting enough to buy. I would ask whether the ratio is cheap enough to respect, whether the rule changes are real enough to matter, whether the physical market is tight enough to care, whether the industrial demand is stubborn enough to persist, and whether the public indifference itself is part of the opportunity. Those are much better questions, because once you ask them, you stop sounding like a gambler and start sounding like an allocator. And in the end, that is what the best investors are, not prophets, allocators. People who understand where capital is likely to be treated best when the world quietly changes shape underneath everyone else. That is what I think is happening here. Not a silver gimmick, a structural repricing setup hidden inside a metal most people still underestimate. And if the last 50 years have taught us anything, it is that when silver gets this cheap relative to stocks and the floor under the physical market starts rising at the same time, the people who ignore it do not usually remain comfortable forever. That is not a threat. It is just history. And history, unlike headlines, has a habit of meaning what it says.